Any questions on this, on the direct method operating section? Okay, so I want to make sure it's clear. Have I finished my statement of cash flows? No. What's missing? Right, the if and OIF, okay, is missing. So we did the O, we didn't do the I or the F, because we're not worrying about that right now because they're the same under both methods. I'm focusing on highlighting the differences now. We just went over the direct method. Now I'm going to go through the indirect method and how it's different. Okay? So let's take a look here. So on the indirect method, you have to start with net income. So even though on the direct method you look at the income statement, you start at the top of the income statement. Under the indirect method, you start at the bottom of the income statement. And that's the only time you're really using the income statement to start with. Well, actually, it's not the only time, but look at the net income number, put that at the top of your operating section, and then pull up your balance sheet. This is important procedurally so that you don't get confused. You start with net income. You start at the bottom of the income statement, get your net income number, and then pull up a balance sheet. Now, we've pulled up a balance sheet. Here's the balance sheet here. We have, forget cash because that's what we're arriving at. That's what we're actually reconciling to. Okay? Accounts receivable is at 60, it was at 40, so accounts receivable went up by 20,000. This is a current asset that increased. Where do current assets go? Which section? Operating. Inventory. The change is 14,000. Also operating because it's a current asset. We're looking at changes year over year in our accounts. Prepaid expenses went up by 2,000. Operating. What else are we concerned with when we're looking at the operating section of a statement of cash flows? Current liabilities. Good. Hope it didn't give it away that I also wrote in operating. So accounts payable went down by 5,000. We have to account for that. Interest payable went down by 1,000. Income taxes payable went up by 10,000. All of these we have to consider all of these items when we're putting together our indirect method statement of cash flows. Now the question is, what do we do with those numbers? Okay? So I had told you my suggestion to you with understanding what direction assets and liabilities move is pick one in each area and know that they all work the same. So let's say we pick prepaid expenses. If prepaid expenses goes up, what happened to cash? It went down because what was probably the journal entry? You debited prepaid expense and you credited cash. So what that just tells us, we can intuitively figure out the rule. When an asset goes up, cash goes down. That's how we can arrive at how these behave for cash flow purposes. When assets go up, cash goes down. Alternatively, if you have an increase in a payable, in a liability, what probably happened? Actually, I'm going to use a loan because I think the loan is the easiest example. If a loan payable goes up, what happened to your cash? It went up because you took out a loan. So the idea is that if any liability goes up, cash went up. So if assets go up, cash went down. If liabilities go up, cash went up. These are the rules you need to understand in order to figure out a statement of cash flows. Okay? So here, we now know what we need to account for. As far as the line items, we know we need to account for current assets and current liabilities, and now we know how to account for them because we know how they behave. So here, the increase in accounts receivable is a decrease in cash. So let me actually back up here. Net income was $38,000 on that income statement. That was given. So you always start with net income. I said always start with the bottom of the income statement. So what are we doing here before I even go through line by line? Here we have a net income number that's on what basis of accounting? Accrual basis. We start with net income on the accrual basis. What do we need to do? put it on the cash basis. So all of these accounts are accrual basis accounts. So we're taking out all of the accruals and leaving only the cash items remaining. Okay, this is the indirect method. We're just taking the bottom line net income number. We're not putting an income statement on the cash basis. We're taking net income as one lump sum and putting it on a cash basis, and backing out all of the balance sheet accounts that affect the accrual basis. So here, accounts receivable went up, cash went down. Inventory went up, cash went down, because all these assets act the same. Increase in prepaid expenses, cash goes down. Accounts payable went down, cash also went down. Interest payable went down, cash went down. Income taxes payable went up, cash went up. Now, that's everything we went through so far. That's all the items that we touched on. Okay? But we're not done yet. I have 3 additional items here. Now, in net income on an accrual basis, we subtracted out depreciation expense to get to the accrual basis. To get to that net income number of $38,000, we subtracted depreciation, we subtracted some loss, and we added some gain on our accrual basis income statement. So I'm just going to back up for a second, just so I can show you and remind you of that. With all these T accounts that I'm not even looking at. So to get to that $38,000, we subtracted out depreciation, we subtracted out a loss, and we added a gain. That brought us to the $38,000. Do those affect cash? Do those actually affect cash in any way? No, so they have to be removed. So in the, here. So depreciation expense was subtracted, so we have to add it back. We have to just remove them. The loss was subtracted from the net income, we have to add it back. The gain was added, so we have to subtract it. So you're removing the non-cash items. So what you do is you look at the current assets, you take your net income, you adjust for the changes in your current assets and current liabilities, and then you remove the items that had a non-cash effect on your net income. Yes? Because you don't need it. Here you're starting with net income, which includes depreciation, it includes a gain, and it includes a loss in that number. So to get to cash basis, you have to remove them. Do you start with anything on the direct method? You're not starting with any number that has it. You're simply re-putting together an income statement on the cash basis. So you just have to ignore it. They didn't affect cash, so you don't include them. See? So here again, we're starting with net income. Net income on the accrual basis includes depreciation expense, it includes a gain, and it includes loss. Okay? It includes all these items that didn't affect cash. So we have to remove them to get to the cash basis. Under the direct method, you're not reconciling from an accrual basis item. You're literally redoing your income statement as if it was cash basis. So you just don't include items that didn't affect cash. That's it. Yes?
Yeah, I think depreciation expenses, I understand it's non-current items, but for the loss and the gains, I don't think it's non-current assets.
Proceeds from those assets go where? From the sale of an asset goes where? Proceeds from the sale of property, plant, and equipment go where? Investing. Proceeds include both the assets basis and a gain or a loss. So that you're incorporating that into the investing section.
So I think the reason for to add them back or subtract them because they are not included in the operating section.
They're non-cash. The gain itself is non-cash. The gain itself is just recognized. It's non-cash. So let me see how I can explain this. I understand what your question is. So if you sell, you sell like an $80,000, you sell something for $80,000 that had a basis of $90,000, okay? So the asset comes off your books at $90,000. Okay? Cash you received was $80,000. So you have some kind of a loss from that sale of $10,000. Okay? That's a journal entry that makes sense, right? You record this, right? So the cash, how much cash changed hands here? 80,000. Cash, the cash effect of this transaction is $80,000. Do we all agree to that? The cash effect of this transaction was $80,000. In the investing section, what do you put? 80,000. You put the proceeds from the sale of this asset. You account for all of that 80,000 in the investing section. It's all in there. Simply, that's what I received for the sale of that asset. Does this loss have any other additional cash effect? No, it doesn't have any cash effect over what the proceeds were. So you have to take it. So if it was a loss, it reduced your net income, you have to add it back. Okay? And vice versa if it was a gain. There's no additional cash effect. So if you were to include it, I mean, the great thing about a statement of cash flows is that if you include the wrong item or you don't include the right amount, it just won't balance. You can't, your cash, we won't come to your ending cash. And you'll probably see, I mean, hopefully if you made a mistake, you made like 1, and then you go, oh, it's that 10,000, I incorporated, I didn't do whatever. Oftentimes there's more than one mistake, and you have to back things out and figure them out. But if you methodically go through and you follow the rules that I'm giving you and the intuition that I'm giving you, you should be able to arrive at what ending cash is. Okay? So this is just the operating section in itself. Are there any questions on the indirect method? Any questions on indirect method? So when you think indirect method, what do you start with? Net income. Then what do? Pull up your balance sheet and look at changes in current assets and current liabilities. This is for the operating section, obviously, only. And if an asset goes up, what happened to cash? Think about this. If the asset went up, cash went down. What example did I give you here? Prepaids, right? If prepaids went up, you must have paid something. You can use whatever asset you want, whatever makes sense to you. If liabilities go up, what happened to cash? Went up. Okay? So like a loan is an example, even though it's not a current liability, it's the easiest one to, they all act the same. And then once you do that, are you done? No, you have to account for items in your income statement that had a non-cash effect. So very common ones would be gains, losses, and depreciation. Amortization would be another. Okay, these are all non-cash items. Okay.